Good evening, sir. I can hear you from my hand.
Okay, that's good. So let us start our class for today. So today we'll be looking at mm, one of the key topics in financial reporting. The reason why it is key is because it is asked every other diet. They ask it every diet, and I would say, it's one of the areas where we would even advise our students to start from with the exam, because of how easy it is for you to get marks from this area of your syllabus. So let's start it. Let's see how far we can go with it. We have to finish it today anyways. But let's see how far you will understand and appreciate it, and get ready for your exam with it. Okay, so the topic again is analysis and interpretation of financial statements. And before I proceed, Victor said he cannot hear me. Let me confirm again. Is it just Victor, or are there other people that cannot hear me before I proceed?
I can hear you from my end.
Okay, so that means, Victor, you have to try and sort the audio of your device. Okay, let's continue. So when it comes to analysis of financial statements, the major tool that your syllabus requires that you understand is ratios. Ratios is a very important tool that is used to analyze and interpret financial statements. All the efforts we have made from the beginning of the diet till now was towards teaching you how to prepare financial statements. On my own side, I have been teaching you accounting standards. All these accounting standards can only strengthen your ability to prepare financial statements. Now, when you prepare that financial statement, you should be able to analyze and interpret this financial statement in a way that to be very easy for anybody to understand. And one of the key tools that is used to analyze financial statements is ratios. Now, there are 5 categories of ratios we are going to look at tonight. The first category is the profitability ratios. The second one is working capital ratios. Yeah, in your exam, you will not find these as working capital ratios. What you will see in your exam is efficiency ratio. I will show you very soon when I get to working capital ratio. And the third one is liquidity ratio. Then we have debt ratio. Then we have investors or shareholders ratio. We would quickly look at these 5 ratios and majorly focus on relevant issues that you need to understand for your exam. So let me start with profitability ratio. The ratios we are going to be looking at here is majorly to ascertain how profitable a company is. And the most important profitability ratio is returns on capital employed, ROCE. ROCE is the most important profitability ratio. And why is it important? Is majorly because it's the ratio that measures the return on the capital. As the name implies, that's what it means. It's the ratio that will tell us that how much were you able to generate from the capital that you had invested in the business. When I say generate, I mean the profit you're able to generate. So now, how do we compute returns on capital employed? That's the first thing that we need to understand. The way it is computed is profits all over capital employed multiplied by 100/1. You have to know this formula. profit all upon capital employed multiplied by 100. This is how you compute ROCE. Now, the examiner will ask you to compute ROCE. Then you need to identify which profits you should use and which capital employed you should use. From your past questions, we have seen that the examiner usually give you the capital employed you should use. They usually give you. And the capital employed you use is what will determine the profit you must use. Again, I said in recent questions, we have seen that the examiner usually gives the capital employed in the exam. Find out that they give the capital employed. And it is important that the capital employed given by the examiner is what you use, because the capital employed that is used will determine the profit that will be used. Now, let's quickly address the capital employed the examiner might give you, or what the examiner will call capital employed. Now, it's either of two things. Number one, is either the examiner simply tells you that the capital employed is equity. They will tell you that use capital employed as equity. And you know that when we say equity, we are talking about share capital plus reserves. That is equity, share capital plus reserves. Or the examiner could tell you that the capital employed should be equity plus non-current liabilities. Specifically, these non-current liabilities are interest-bearing debts, meaning that the non-current liabilities that you pay interest on, like they will tell you 10% loan notes, or they tell you 13% preference shares, those ones are interest-bearing debts. So ordinarily, we would not expect that you should include deferred liabilities, deferred tax or provisions or other items like that that are not interest-bearing. We don't expect you to include them when you are determining these non-current liabilities to be added to equity for you to determine your capital employed. Now, back to the main thing. So the examiner can give you, they will tell you, like it's going to be very clear, that use capital employed as equity, or use capital employed as equity plus non-current liabilities, or plus, they could just say plus borrowings generally. That's how you would find them calling it. Now, when the examiner tells you this, please, you have to do exactly what the examiner tells you. Okay, so having determined the capital employed, which could either be equity, just equity alone, or it could be equity plus borrowings, that is interest-bearing debt that you pay interest on. Then what would then be the profit? Listen very closely. If the capital employed is just equity, okay, that's what I have in this paragraph here. If the capital employed is equity, then the profit you must use must be either profit before tax or profit after tax. Again, if the capital employed is equity, then the profit you must use must be either profit before tax or profit after tax. Why are we using this profit? You will agree with me that your profit after tax is the profit after you have paid all your expenses, both cost of sales, admin, interest. So this is the profit that ordinarily belongs solely to the shareholders. So where the capital employed is equity, which represents shareholders, then the profit should be the profit due to those shareholders. And that's why we are using profit before tax or profit after tax. So we are more comfortable using profit after tax because, I mean, you have just removed the tax. We know that, okay, this is a free profit that belongs solely to the shareholder. However, if the capital employed used is the equity plus borrowings or equity plus non-current liabilities, then the profit you must use should be the profit before interest and tax. The profit before interest and tax, which we'll also call operating profit. And from the name of that profit, profit before interest and tax, which is the profit before you pay your interest. So that PBIT includes a portion that belongs to the debt holders in form of interest. So where the capital employed is equity plus borrowings, that means the profit should be profit that belongs to equity and borrowings, which is the PBIT. So it always is going to be very clear there because if you can do something you would figure out and see very clearly in the exam. So what you must know additionally is that the higher this profit, the better. The higher this profit, the better. Okay. So on Friday, yeah, I was doing a comparative analysis of the financial statement of UBA, Zenith, and GTBank, right? So I saw that with the same capital employed, UBA and Zenith were doing over 2 trillion as their gross earnings, but GT was doing like around 1.6 trillion as gross earnings. However, when we got to their profits, we saw that even though GT was doing a gross earnings of 1.7 trillion, their profit was well above Zenith and UBA. That was doing over 2 trillion. Their profit was like almost 759 billion, right? So when we looked at what caused that, we saw that GTBank was managed their costs very well in such a way that ultimately, by the time you compute ROCE of GTBank, is going to be well and above those of its competitors. So in terms of profitability, they are better off as far as profitability is concerned. So that is the ROCE. Is something you would always have to do in the exam. Now, the second ratio is returns on equity. Indirectly, I have already explained this in ROCE because from what I've explained, if the capital employed is equity, then the profit should be profit after tax. If those are the indices that is used for those two variables in ROCE, then ultimately is the same thing as calculating returns on equity. So I won't repeat this again, really. So, I mean, this one is just focused on where the capital employed is equity. So automatically, you know the profit you have to use is either PBT or PAT. Well, I told you that we're always geared towards using PAT. So ROCE has already captured these returns on equity. The next one is profit margin. And when we say profit margin, we are talking about the amount of profit you are able to make on every sales. The amount of profit you are able to make on every sale. So it's usually your profit over sales. So mostly you find them multiplying it by 100 so that ultimately the profits or the resulting figure we get is going to be in percentage, right? So the core thing here is this. Of course, the higher the profit margin, the better, right? So when you're able to make good profit margin, it means you are doing very well. Like the example I gave you of Zenith, UBA, and GT that analyzed, where UBA and Zenith had extremely higher revenue or sales, but GT beats them in terms of profit. When we checked their profit margin, we saw that GT Bank was still better. However, the examiner is usually specific with regards to this profit. The examiner can either call this gross profit margin. So when the examiner says gross profit margin, that means the formula becomes gross profit over sales. But where the examiner says net profit margin or operating profit margin, that means the profit you have to use here is operating profit or PBIT. Whether they call it net profit margin or operating profit margin, right? So be wary of the name the examiner calls this. This is how to compute it. And of course, the higher, the better. A company that has a higher gross profit margin or net profit margin, it's seen to be more profitable. And finally, is asset turnover. And this speaks to how well an entity is able to convert its assets to sales. How well an entity is able to convert assets to sales, asset turnover. So, and an easier way to remember this formula, which is sales over capital employed. Some places you will see this as total assets. I'm just comfortable using capital employed because it's just measuring the same thing. And using capital employed here would ensure that whatever I use as my capital employed in row C here, in row C, whatever I use. So if a question has row C and asset turnover, whatever figure I use as my capital employed under row C is exactly the same figure I'll come and use under my asset turnover. So it makes life easy for me and even for the examiner. So it's sales over your capital employed. Okay. So this will show us how many times you're able to convert your assets to sales. The example I gave you of GT Bank and those other entities, and I mean before this recapitalization, their capital employed is their capital base was 50 billion, and from the example I gave you, it means that if you put let's take GT for example now, 1.6 trillion. You put it on 50 billion. Yeah. You can imagine how many times, because this looks at the number of times, right? That's more than 20 times. More than that, that's extremely good. So the higher, the better for these as well. And that's asset turnover. And that is it about profitability ratios. This is it about profitability ratios. So if you know these 4 ratios, then you are good to go. Now, before I move to the next category of ratio, which is the working capital ratios, I want to ask you a question. I don't know if you are still here with me. I hope you are not sleeping. I want to ask you a question. And the question is this. If the examiner, let's say you go to the exam hall and you see, let's say the examiner asks you to compute cost of sales ratio. The examiner asks you to compute cost of sales ratio. Cost of sales ratio is not in these notes, right? I didn't plan to even talk about it. I'm just saying, and I didn't teach you. and they ask you to compute cost of sales ratio. So how would you have been able to get like 2 marks in the exam? Can we think about that together? Cost of sales ratio. I mean, this is the part where you unmute yourself and talk. Anybody? Cost of sales ratio. Go in. Anybody? Anybody? Okay, nobody. Okay, so in the exam, cost of sales ratio will have been your cost of sales over your sales, right? So this is just similar to gross profit margin, which was gross profit over sales, right? It's just gross profit margin is just the amount of gross profit you make on every sales. Then cost of sales ratio will be looking at the amount of cost you incur on every sales. Okay, I mean, I'm surprised that none of you could make an attempt. Really surprising. You could find something like that or something entirely you have not seen before in the exam. Please, students that fail are students that don't attempt and just leave it. I don't know. If you attempt, you get something. Again, but the major challenge when they asked it that diet is that the examiner didn't give us cost of sales, neither did they give us sales. They didn't give us this element. So, yes, Victor, yeah, you're correct. You're correct. You can see cost of goods sold over sales, yeah. So when they asked this, what the examiner gave us was gross profit margin. They gave us gross profit margin of 25%. And they asked that we should compute cost of sales ratio. And they didn't give them this. They didn't give them cost of sales. They didn't give them sales. I mean, the answer was a cost of sales ratio. The answer is 75%. 75%. Because if gross profit margin is the amount of gross profit on every sales, the difference between sales and gross profits is cost of sales. So on every sales, you are making 25%. That means the cost is 75%, which is the cost of sales ratio. And that was what we were just supposed to do to earn 3 marks that diet. So you can think about it later on. I'm just exposing you more. Now let's go to the next category. So the next category here is working capital ratio. Like I was telling you earlier, we have gotten used to the examiner calling this just efficiency ratio. So I will really focus on efficiency ratio. So I'm not really going to talk about these working capital turnover ratios. In the exam, you will see is efficiency ratio they will ask you, right? So there are 3 efficiency ratios here. There is the trade receivables collection period, inventory turnover period, then we have trade payables payback period. And from the name efficient, really, we are looking at how well an entity is able to manage its working capital. And, the element of working capital, inventory, cash, trade payables, trade receivables, all of that are elements of working capital. So how were you able to manage them? So these 3 ratios takes care of efficiency ratio. So the trade receivable collection period, in your exams, we have seen the examiner simply call it collection period. We have seen them call this ratio debtors in days, right? We have even seen them call it trade receivable turnover period. Okay, they have called it all of these names in the past. Just know that this is what you're talking about, and it is computed as your trade receivables all upon sales multiplied by 365 days. You see, your trade receivables is just the trade receivables in the statement of financial position. Don't use average receivables or whatever. No, they don't call it debtor turnover. Debtor turnover is another thing entirely. It's debtors, you have to add period in front of it. Maybe debtors turnover period. That period is important. Okay, Joyce. Okay, like I was saying, the trade receivable here is the trade receivables in the statement of financial position for that year. Don't use average receivables. Don't stress yourself. Don't go and be using opening, closing divided by 2. Don't do that. It can even confuse you. Use the trade receivables they gave you in the statement of financial position. Credit sales. Don't start looking for credit sales up and down, except the examiner specifically tells you that this is credit sales. Use the sales. Is sales in almost 100% of all the questions we have seen. Trade receivable over sales, then multiply by 365 days. Your answer will be in days. Your answer will be in days. And for proper context, this ratio looks at the number of days it takes to collect your money from your debtors or from your receivables, the number of days. So the earlier the better. Abi, the earlier the better. Collect your money early. So when you want to judge any company with regards to this ratio, it's the ones that are collecting money earlier. Because if you collect your money early, you have money to pay to settle your liabilities as early as possible. So the earlier the better. And in the exam, whenever they ask you to compute ratio, you are going to be comparing it with something. Is it that you are comparing it with another entity, or you are comparing it with last year, or you are comparing it with industry average, or you are comparing it with industry average. So whatever it is you are comparing it with, that's what I'm telling you. For all of the profitability ratios I've looked at, the higher the better. This one, receivables in days, the lower the better. So it's the guy that has a lower receivables that is doing better, that is more efficient. Okay, so enough of that. Now the next one is inventory turnover period, which is inventory over cost of sales multiplied by 365 days. This inventory here is your closing inventory. Please don't go and be doing opening inventory minus closing. Don't do that though. Don't waste your time though. It's closing inventory. Just pick your closing inventory from the statement of financial position. Pick your cost of sales from the statement of profit or loss. Multiply by 365 days. And that is it. Whatever you get will be in days, right? And it really looks at the number of days it takes to sell your inventory, or the number of days before you were able to take the inventory out to the customer. I mean, it's just how many days it takes you to sell. That is it. That's inventory in days or inventory turnover period. So, and finally, for this one also, the earlier the better. Yes, now, sell early so that you can have money to do some other things. I mean, you are converting your inventory to sales. It's good. The earlier, the better. So is the entity that has a lower inventory turnover period that is seen to be more efficient. Then finally is trade payables turnover period. Trade payables turnover period. For this one, is your trade payables all upon credit purchases multiplied by 365 days. Multiply by 365 days. So this your trade payables is just the trade payables in the statement of financial position. Credit purchases, if they give you purchases, fine. Don't start looking for the one that is credit. Though that's the formula, right? But if they give you purchases, use purchases. Even if you don't have purchases, don't start doing one formula to get purchases. Use your cost of sales. Please use the cost of sales and move on, right? So you can use your cost of sales here. And whatever figure you get is the number of days it takes you to pay your suppliers. The number of days it takes you to pay your suppliers. Okay. Again, this one, is it the higher the better or the lower the better? Okay. I mean, some of you might think the higher the better, that you should delay payment to your suppliers. That is not good. That is bad. So some people say, yes, now, if you delay the payment, then you'll be able to convert that money to somewhere else. That shows that you have liquidity problem. Because why should you be converting your supplier's money to something else? That means you have liquidity problem now. If you don't have liquidity problem, pay him and buy another goods, right? And even if you pay him early self, it improves your credit rating, especially in an environment where credit rating works. It increases your credit rating. That before next time you want to buy, before you even mention Jack, the guy will have delivered goods to your doorstep. So for payment period or trade payables turnover period, the lower the better also. The lower the better. Don't delay payment to your suppliers. An entity that is paying earlier is better. That shows that it's creditworthy. That shows that it's doing a lot of activities. That shows that it will get even better credit in the future. Because somebody gives you goods on credit, you're not paying. There is no way you can get that kind of credit. If you go to the bank to collect money, they will charge you interest. This guy gave you the goods. So the best you can do is that at the earliest time you have the money, pay him. Pay him. And the way you should interpret it in the exam for an entity that is having an elongated payment period or payables turnover period, you should interpret it as that it might lose future credits and it might be an indicator of liquidity problem because the entity might be diverting that money to other sources because it doesn't have any other money to run as working capital. That is why it's using its supplier's money. Okay, so yeah, that is efficiency ratio, those three ratios. Now, efficiency ratio is very powerful, extremely powerful. So I want to make a few comments on them based on what I kind of asked you in the past and which they could still ask you. But before I make those additional comments on these three ratios, is there any question or concern up to this point? Okay, now the first thing is this. Trade receivables collection period. If you aggregate it with inventory turnover period. Let me put it below here. Let me put it below here. Let's say your trade receivables in days, let's say is 10 days, for example now. And your inventory in days, let's say is 12 days. That means the addition of the two, we'll be looking at around 22 days, right? Is there anybody in this class who can tell me what does this 22 days represent? Anybody? If trade receivables in days, meaning it takes you 10 days to collect your money from your debtors, it takes you 12 days to sell to your customers. The addition of the two is 22 days. What does this 22 days mean? Okay, so I won't waste our time. This 22 days represent the number of days it takes to convert your inventory to cash. Number of days it takes to convert inventory to cash is this 22 days. Okay, because
period.
Yeah, Emeka, you're saying something?
Is it turnover period?
No, it's not turnover period though. It's just as I've mentioned, it's the number of days it takes to convert inventory to cash. It's not turnover period. It's just that, right? Number of days it takes to convert inventory to cash. So 12 days to sell. Then when you sell, additional 10 days to collect your money from the people you sold to. So altogether, 22 days to convert that inventory to cash.
Can we say operating cycle?
No, you can't. You can't. So you can only say operating cycle after you have now settled back your trade payables. So the trade payables in days, for example, now, if let's say that is what I'm thinking about is this: a good company trade payables in days should always be higher than your receivables in days, because we expect that if you take 10 days to collect your money from your receivables, it's the money you collect from receivables that ordinarily you should use to pay your trade payables. So this one should be like 12 days. It should be higher than this guy, or even 14 days. Take time, right? Take enough. I mean, you would have negotiated with your supplier to ensure that, okay, when you collect money from your receivables, just pay these other guys. So the guy that said operating cycle, right, is after you have removed this guy. When it takes 22 days to convert to cash, right? Then out of that 22 days, 14 days belongs to suppliers. So it's when you have removed this one, then you will then be talking about an operating cycle. Then here now you are talking about an operating cycle of 10 days. Sorry, 8 days. 8 days. But you see, this operating cycle of 8 days, the examiner, I've seen them call it cash cycle. I've seen them call it, they've called it trading cycle. I've seen them call it conversion cycle. Conversion cycle. I've seen them call it working capital cycle. Right? Which other name do you know apart from these ones? So they could ask you to, like, they could call it any name. When the examiner mentions that compute or calculate operating cycle or cash cycle or trading cycle or conversion cycle or working capital, just compute these 3 ratios for them. It's always like 8 marks, sometimes 12 marks. If you see that kind of question, just go and do that one first. Your trade receivables in days, plus your inventories in days, minus your trade payables in days. You see, what this operating cycle really means is the number of days it takes an entity to start and finish a transaction. How many days it takes you to start and finish a transaction, right? And of course, the lower the better now. If you finish transactions earlier, that means you'll be able to start another one. Then and that will show how profitable you are as a company. So the lower the better. Okay. And another thing is this, which I've seen as a singular question in your exam for 15 marks is this. You see, when it comes to operating cycle, there is usually a problem attached to where an entity has an elongated operating cycle, or where the operating cycle is too is large, is elongated, is long. There's a problem attached to that, which is a popular problem that we hear. Do anybody have an idea of what that problem is? A company with an elongated operating cycle. What problem is that? Any idea? Overtrading. It means the company is overtrading. And when we say overtrading, listen up. It means that a company is doing too much, too quickly, with very little resources. An entity is overtrading when an entity wants to expand its operation, or when it is doing too much too quickly with very little resources. Let me paint a scenario for you so that it will be more interesting. So let's say a company has a capital of 20 million naira. And this capital has can only produce, let's say, 10,000 units realistically. So if you invest the entire 20 million, you would produce 10,000 units of inventory to sell. However, this guy wants to intend to produce 100,000 units. 100,000 units. Knowing fully well that his 20 million cannot, it can only do 10. It can, but this is his target. This is what he wants to do. So this guy will end up overtrading. If you would see, if he's able to achieve this 100,000 with this little capital, first is that he will have borrowed. There's no way he will have done it. He will have borrowed, either from bank or he will have borrowed. That's one of the symptoms, how you will know. Number two, the second one is that this guy is going to have a negative cash balance. He will have a negative cash balance. Not only that, this guy is, he will have, there will be like a sharp increase in his sales. There will be a sharp increase in sales because he will have produced so much that he will have to sell them. This sharp increase in sales would result into huge trade receivables. For him, it's going to result in huge trade receivables because he will now be selling to wrong, exactly, more credit sales, to wrong set of people that will not pay. And he will be giving like a very generous credit term, which is what is boosting that revenue. So his trade receivables is going to be very huge. Not only that, because he doesn't have the resources, his trade payables also will be huge. He will have been buying from the suppliers on credit and he will not be able to pay back. Trade payables is there, huge. And for him to have been able to do 100,000 units, he will have invested additional PP or non-current assets. So I've mentioned like 6 or thereabouts. These they have asked before in the exam for 5 marks. So, and it's extremely logical. Symptoms of overtrading. High level of borrowings or loans. You will have to acquire PPE to fund the additional or productive capacity. He will be given very favorable credit terms, so his trade receivable will be huge. His trade payables huge. There will be a sharp increase in sales, bank overdraft high, even taxes will be high because my guy is going to be making so much profits since he's able to achieve sharp increase in sales. And government does not care whether you have the money or not. They compute your tax on your profit. So his tax, it will be huge. He's in a lot of mess. So then the next rational thing to do is that, what's the solution in this case now? They can ask you in the exam that what's the solution? The first solution is that you should have a sit down with the bank and restructure these loans. If you can, restructure the loans. Is either he asks them to, maybe they should forgive him some interest. They will never forgive you capital. You will pay back your capital. They can forgive some interest and say, okay, would if the interest you are supposed to pay is, let's say, 20 million, they can say, okay, pay 5 million. They can do that. Okay. Sorry, I think my internet just went off now. Can you hear me now?
Yes, sir.
Okay, yeah. Okay, so like I was saying, the first sit down is that sit down with the banks and restructure these loans. Either they cancel some of the interest for you, or they extend the period, or they reduce the interest rate you are paying. Sell some of those, disposal of PPE, sell some of this PPE. It can factor the receivables. Yeah. Yeah. The guy can, yes. Onyeka said, get additional capital. Yeah, I agree with that. Inject capital. Yeah. So when I say factor receivables, it means get somebody that can go after the receivables and collect those money for you. It usually come at the costs. So get somebody like that. And what again? What can this guy do again? He can also discuss with the supplier to increase with suppliers to increase the credit period granted. Okay, we have spent almost 30 minutes on efficiency ratio. Yes, it is that important. It is that important. We won't spend that much time on the other ones. Yeah, what if there is less receivables but more cash payments? Victor, I don't get what you meant.
Sorry. I mean, in this, can you hear me?
Yeah, I can hear you.
So in this situation of overtrading, some of the symptoms which you mentioned is huge trade receivables,
Yeah.
meaning the customer has a lot of inventory and he sells them on credit, right?
Yes.
So what if it's not the situation of selling on credit? What if he has a lot of cash sales and lower trade receivables? So would that still be considered as
That one
an
is not,
overtrading out of control?
no. That one is not overtrading now. That one is very good. You have money. You have money. You have lower trade receivables. That is extremely good, right? And that's not even, that is different from overcapitalization. Overcapitalization is different. So that ones, you are not, overcapitalization, you're not doing so well and you have so much money, right? But if you have so much money that is not your capital, money that you have made from revenue, that one is good. So that one is not, it's far from overtrading. It's not overtrading. Yeah, but
But,
fantastic
but,
contribution.
but what if the capital gotten is from borrowing from the bank, and after borrowing from the bank, instead of you to have a situation of overtrading where your customers buy on credit, then your customers buy with cash payments, is this still regarded as overtrading? Even though, yes, you are trying to expand your operations faster than you should by borrowing money from the bank.
No, that would be very
That
good because
customers are buying. What would
then
you call that?
that one is not a problem anymore. Like I've mentioned, that means he's extremely lucky. Okay, so if he is able to sell and customers are now paying, that means he will be able to pay back all these borrowings, will be able to pay back the suppliers, his bank overdraft to not exist. So, I mean, the major determinant here is that he's selling so much, but the receivables are not paying. So this scenario you have painted now is not overtrading. It's not overtrading again if customers are paying. Okay.
Okay. So
Exactly.
what I am getting from this is it is not so risky. It is not such a bad idea to want to expand and get borrowings from the bank. It is only going to be bad if you are not able to convert your inventory into cash quickly.
Very correct.
All right. Thank you for the clarification.
You're welcome. Yeah, that's a good initiative. Okay, so let's move away from all of this. Let's move to liquidity ratios. So majorly, two liquidity ratios. And first is current ratio, which is current assets over current liabilities. And from the name liquidity ratio, you will see that the focus is on cash. Cash. Are you liquid? So, and the best measure of whether a company is liquid is to see whether they can pay their liabilities. So, which is this current ratio. Looking at, do you have sufficient short-term assets to pay your short-term liabilities, right? So again, the higher this ratio, the better. 2:1, 3:1 is always something ratio 1, right? Because this is going to be like the basis. So if you have 2:1, that means current asset is over your current liabilities times 2. That means you have more than enough. So again, ultimately, when you're judging a company, the higher the better. Is one that has the highest that is good enough, right? That's for your current ratio. The same in a similar manner is quick ratio or acid test ratio. They measure the same thing as current ratio, just that now the numerator of current asset now, we want to even consider a more liquid current asset by removing any item of current assets that will take quite a number of days or months before you can really convert them to cash. Because in reality, when we talk about liabilities, you would really mostly have to pay these people in cash. Yes, we know there are non-cash consideration, but the bulk of it is going to be cash, right? So we would want a situation to have a ratio that would be close to, do you have assets that you can quickly convert to cash, then use it to settle these people? Then the go-to ratio is quick ratio or acid test ratio. Popularly, we remove inventory from current assets, then divide by current liabilities. The higher this ratio, the better, right? Now that shows that this company is liquid. It has sufficient highly short-term assets to settle highly short-term liabilities. Okay, but that is not to say that other items cannot be deducted from this numerator, provided the examiner has specified that also remove this, or they have given you a clip. They could say that certain amount of receivables takes a long time to convert to cash, or they could tell you that we cannot even recover it again. So just remove that from here. Or they tell you that prepayment will take a long time. Just remove it from here. So by the time they are giving you such a clue, then you probably would remove it. But I can tell you from experience that ICANN has never done that before. So for your quick ratio, be sure that you would only be removing inventory from current assets. Be sure of that. Now, before I move to debt ratio, which is the next ratio, I want to quickly chip in an even better ratio for liquidity ratio, which we will call cash ratio. We'll call it cash ratio. So this one is logical that in that we want to even put cash on current liabilities. That do you even have cash, raw cash in the bank to pay this set of people? And then we call that cash ratio. We believe that's the best measure, that if your liabilities come knocking today, you can ask them to send their account number and do transfer almost immediately. That means you are highly liquid, right? And I've seen your exam asking you to compute cash flow ratio. So, I mean, why not just add it as part of your liquidity ratio? Call it cash flow ratio, which is the availability of cash. Let me call it cash equivalents. Maybe fixed deposits, demand deposits, divided by your current liabilities. Yeah, is also a liquidity ratio too. Note it. Now, debt ratio. So for debt ratios, the focus here is this, right? We majorly want to see whether an entity can pay its interest. Debt ratio here is considering entities that have long-term liabilities like loans, debentures, and all of that. So the ratio we are going to be learning here will show us that, okay, can you pay these people? Because when you have these long-term loans, they come with a kind of risk that we call financial risk. And this financial risk is the risk that you might not be able to pay them as and when due, which might result in liquidation. Debt holders can liquidate a company, especially if they owe the lien on any of the assets of that company. Holding a lien means that if you fail to pay, they can sell that asset. By the time somebody starts selling your assets, you're out of business already. So they can liquidate the business if you don't pay them. That's a financial risk. Risk that you might not be able to pay as and when due. Number two is that the risk that the amount of interest you will pay will be so much that there will be little or no remaining profit to give to your shareholders. That would affect your market price because shareholders will not be happy. It's not like you made huge profit that you are retaining for growth. This one, you did not make profit as a result of huge payment of interest. It's a financial risk. Okay, it's a financial risk. So they come with debt. Now, with that background knowledge, the first ratio I'll be looking at is debt ratio. which is total debt over total assets. Total asset being current asset plus your current liability. Sorry, current asset plus your non-current assets. Total debt here is current liabilities minus non-current liabilities, but we usually don't add deferred tax, provisions, all of those. Those ones are not really like debt. We are mostly concerned about debt that you really have to pay, that if you don't pay, somebody can liquidate you. So putting that debt on our assets gives us an idea of the portion of our asset or proportion of our asset that is financed by debt. That is debt ratio. Okay, that is that. There is gearing ratio, which you find the examiner might also call leverage ratio. Leverage ratio in the exam. So this one is majorly interest-bearing debts. So some will just simply call it debt. I mean, I expressively I called it this for you to know that I'm talking about debt that you pay interest on, right? That's what we are considering here. Usually the long-term debts that you pay interest on. So all upon this interest-bearing debt plus equity multiplied by 100 will give you your gearing ratio. Or it could simply be debt to equity ratio. So I've seen examiner ask this as a separate ratio. They will just simply call it debt to equity ratio. So you just put your debt against your equity, right? Ultimately, they are measuring the same thing, right? It's just trying to compare that, okay, what's our debt to our equity? Trying to weigh the two together. If we are using this, right, a ratio above 50% here is bad. It goes to show that your debt is more than your equity. It goes to show that it's not the shareholder that owns the business. They call that highly geared. This one, a ratio above 100% is also very bad. It shows that the entity is highly geared. Okay? It shows that it's bad, it's not good. It's not good. Because any mistake at all, you're gone. And you cannot even borrow more. That's the worst part of it. You can't borrow more because by the time the lender looks at your books, he sees that, guy, your debt is already overburdensome. I can't give you additional money. And you will have even used most of your asset as collateral and all of that. There might not even be any more asset for collateral in there. But this leverage ratio, yeah, debt to equity, looking at proportion of debts in your capital structure, like that. There's another one called interest cover, which is PBIT over interest charged. So this is just still looking at, okay, can your profit sufficiently cover your interest? This would be of particular importance to shareholders, right? So by the time shareholders see that your PBIT is almost times 6 or times 7 or times 10 of your interest, their mind will come down. They are safe. They know that come rain, come shine, you can close your eyes and pay your interest. And there will be so much profit left for them to even share. So that's what interest cover does. It tells you how many times can your profits comfortably pay your interest. How many times does it cover it? Like that. So they call it interest cover ratio. So of course, the higher the better. This gearing ratio and debt ratio up here, the lower the better. Don't just, the lower the better. Nobody is saying you should not get debt, you should not leverage. When it's too much, it becomes a problem, it becomes a burden to the company, to everybody. And there's cash flow ratio. I mean, I've mentioned this cash ratio up there when I was looking at liquidity ratio, where I put my cash and cash equivalents on my current liabilities. Here is the same thing. I'm just testing. Does this guy even have the cash to pay these interest-bearing debts? So I call that cash flow ratio. While the other one up there, I call that cash ratio. So majorly, I want to look at cash on my interest-bearing debt. So this total debt, current plus non-current, but I mean, like I've mentioned earlier, we would be omitting items like deferred tax, provisions, all of those ones. Just we are looking at debt that you have to really pay, that you would really pay, that are on your neck, like we are got pay, like that. And this net cash flow, we find out that if they give you cash flow statements, it's more ideal to use the net cash flow from operating activities. It's more ideal to do that. But if they don't give you cash flow statement, just simply use the cash in the statement of financial position. Yeah, okay, we are good to go. And the final one is investors ratio. So this is of particular importance to investors. From the name, you will see that. And we have dividend per share and all of that. So from here now, the first one was earnings per share, which is the profit attributable to ordinary shares all over the number of ordinary shares. That's EPS, that's the earnings per share. So this majorly measures the financial performance of a company, because it's looking at your profits, breaking your profit down to shares. Okay, so earnings per share, profits to ordinary shares over a number of ordinary shares, or simply profit for the year over a number of ordinary shares. And there is dividend per share, similar to earnings per share. So this looks at the dividend all upon the number of ordinary shares. And there is dividend cover. Turn again. There is dividend cover, which looks at how many times your profit can pay your dividend, which is profit over total dividend. Some people can even put it as EPS over DPS. Okay, looking at it per share, EPS over DPS, dividend cover. And there is PE ratio, or your price earnings ratio, that from the name we get the formula, price earnings. So the price speaks to market price, the earnings speaks to earnings per share. And this ratio majorly is used to measure the confidence that the shareholders or the investor has in a company, the confidence they have in its ability to grow. Because, of course, PE ratio, the higher, the better. For a company to have an high PE ratio from this formula I'm looking at here, it means its earnings is small, but its market price is relatively much larger, which is an anomaly, because when earnings per share is small, shareholders will tend to frown and sell those shares. So when sell becomes significant, share prices will come down. But in this case, market price happens to be going up, which goes to show that even though this company is not making so much earnings, people are still buying its shares. That's why its market price is going up. It shows that people are buying and holding, they are not selling. It shows that they have confidence that, yeah, this company will grow. That this company will grow to grow. And usually this would apply to most of these tech startups or some of these blue chip companies that have huge future potentials like that. So you'll find out that PE ratio is one of the ways in which these startups are measured, are valued. That's why you see a startup that has not even started making money being valued in billions of dollars. Is the confidence we're actually talking about. Confidence and trust is extremely important. You have that, you have everything. Then there is dividend yield. This is one of the best measure of returns to investors. because looking at your dividend vis-a-vis your market price, look at it. If there are two companies now, company A, let's say, pay a dividend of 2 naira. Company B pay a dividend of 4 naira. You know, ordinarily you'll be tempted that company B is better. Not until you see that to buy the shares of company A is 1 naira. So you are investing 1 naira per share and you're getting 2 naira per share. That's like double. But to buy the shares of this guy is 4 naira. You invest 4 naira, you are getting dividend of 4 naira per year. This guy is better. And that's what dividend yield does for you. It tells you the return relative to the market price. And there are other investors ratio. There is dividend payout ratio. There's dividend payout ratio, which is the proportion of your dividend of your earnings that is paid out as dividend. So how can we compute that? EPS over, DPS over EPS. Proportion of your earnings paid out as dividend. There is even dividend retention ratio, which will be EPS minus DPS. That will give me my retained, what I'm retaining, over the EPS. So proportion of my earnings that I'm retaining. Okay, retention ratio. Okay, so yeah, that is it for the ratios. So your first challenge here is to understand this ratio. I have the notes here, you can look at them. I will just forward these things to you, to your WhatsApp group. So these are the things you need to look at yourself. I won't really take my time reading this through for you. You need to look at the limitation of ratio analysis. I've seen them ask this, limitation of ratio analysis. You need to also look at limitation of financial statements. You need to look at those ones. They are quite straightforward. You can leave this analysis of statement of cash flows, leave it for the CR students, a little bit above your level. So this is that diet that was telling you that ICANN was asking you to calculate cost of sales ratio, right? And they didn't give us cost of sales. All they gave us was gross profit margin. And they asked you guys to calculate cost of sales. It's just the balance out of 100%. It's just 100% minus this. Will simply give us cost of sales ratios. And they wanted you to calculate earnings yield. Earnings yield is EPS over market price. Okay. The EPS, they already gave you EPS here. And they didn't give you market price, but you can get your market price from here. Since you have PE ratio, and PE ratio is market price over earnings equal to this. So since you have earnings and you have this, multiply earnings by this, gives you the market price, then which is 0.3 multiplied by this times 5.6 will simply give you the market price. Then you can simply get your earnings yield. Okay, and they ask you to draft a report to the chief accountant. When they say draft a report, you have to draft a report. And what makes it a report is just that from to subjects, from to date, then subjects. Then you write your whatever you want to write. Then you sign at the closing part. Yeah. So this was asking us to advise on the desirability of the acquisition. So this one, that means they don't even want you to compute any ratio because they have given us all the ratios. It's just for you to interpret. And I think they want to acquire one of these companies. Okay, they want to acquire Worry Health. The board want to acquire in Worry. So by the time you compare, all we'll be comparing is Worry with industry average. You just be comparing worry with industry average. So by the time you look at when you want to advise, you have to be an analytical step by step. You start with profitability. You can write profitability as a subheading under your report. You have your gross profit margin. You can see the gross profit margin of worry is 38.5%. That of industry is 34.5%. This shows that worry is doing better than industry in terms of its ability to convert, in terms of the amount of gross profit is making from every 1 naira of sales. This one is expense to sales margin. Worry is doing 5%, industry is doing 15%. It goes that worry is managing his expense better than most companies in the industry. It's 5%. He's using 5% to generate so much sales. And net profit after tax margin, this guy is doing 9%, and this guy is doing 20%. This is quite surprising. It's quite surprising. I mean, we will need to have further information on what have caused the net profit margin to be so low. Because he's doing so well here, he's managing his expense. How come net profit margin is very poor? 9% against industry is doing 20%. So these are one of the areas where further investigation have to be made. But I mean, here, his net profit margin is poor. So that means he's not managing his operating expenses better. I mean, we'll just say that. So liquidity ratios too, in terms of current ratio, is doing better. And as I'm saying it, that's how you'll be saying it. No, there's nothing difficult there. Just say it. When they say analyze, just say it. Say what you see. The current ratio is 5.1. Industry is 2.1. It shows that Worry Limited is more liquid than industry in terms of its current ratio, which shows that it has more available current assets to settle its current liabilities. Then quick ratio is also better. So it means they even have highly short-term assets, better than industry. So debt ratio, this guy has a lot of debt, 65%. And unfortunately for him, he cannot even cover them with enough profits. 0.0. He's not even up to 1 times. This is very bad, extremely bad. So he has so much debt. So, and EPS, yeah, better than industry. P ratio, better than industry is okay. Then we added cost of sales, but I mean, so all of those things, you just pick them. That means you have to pick these ratios one by one and be talking about them. That is what will have earned you this 13 marks. And you have to conclude because you want to evaluate and advise on the desirability. So you need to conclude and say that this guy is profitable, though his net profit is low, mostly because maybe he's not managing his operating expenses good enough or he's paying so much tax. You need to identify the fact that he's liquid, but he's exposed to huge financial risk. So you now leave it to the investor to decide. If his risk appetite is high, then he can go ahead, but you should be ready to settle up. This guy is liquid, right? He's profitable. That means he has the money. So you should just settle up these people, right? Because they are taking so much. I think that's why the net profit margin was even so low, because of interest. That will most likely be the case. Okay, so I'll be releasing you very soon. I just want to show you one final question. Yeah, this one. I will need you to look at this. So this was one I was looking at. They said, discuss 3 signs which shows that a cocoa is suffering from overtrading. Identify the causes of it and recommend solutions, right? So if you look at their financials, 2013, 20 million, 2014, 360 million. That's where the problem started. Very sharp increase. Look at this one. Expenses, 3 million, 50. Interest, 0. 10. Tax, 2. 60. PPE, 20. Multiplied by 4. Inventory. Bank became negative. In fact, if you check his working capital, if you look at his working capital, the current liabilities was 190 plus 50. That's like 240. Current asset is 300. I mean, current asset is 270 minus 50. That's 220.
Excuse me, sir.
Yeah.
Sir, this bank that became negative, I think it's an overdraft.
Yes. It is an overdraft. So it's one of the indicators also. So if you compute its working capital too, you see that that one is negative. So all of those are signs that this guy is suffering from. And what really caused it is just for you telling them that because he wants to do a lot of sales, right? He wants to do so much sales, achieve a lot that his resources cannot. That's one of the things that actually caused. That's the major thing that caused his problem. And he was buying so much assets. Yeah, he was doing so much inventory. So these are and he was unable to collect money from his receivables. So you can then be giving him that solutions that I told you about, getting a factor, injecting capital, restructuring the loans. I give you some other ones like that.
It's PP.
Yes,
Sell some PP.
yes, some of this PP and all of that. So guys, this topic is easy, right? And I would need you to pay good attention to these parts of your syllabus. I've already collated most of these past questions in one place for you, right? You can always check the ICANN website to get more details for these past questions. But it's an area you really don't want to joke with. It's an area you want to really pay maximum attention to, right? So, because an area that always comes out in the exam. So I'm going to stop here for today. So
I'm coming.
next week, Saturday, right? Arguably might be our last class and it might not, right? It depends, right? It depends on us. But what I want to teach you next week, I will be discussing about ethics next week because it's 5% of your syllabus. I'll be teaching you, so it's theory. It will not take 15 minutes for me to teach you that. I'll just basically show you one or two things and some past questions. Then I will teach you blockchain also. That one will not also. So those two together might take around 40 minutes. And I think I want to talk about one additional standard. I think it's IS 20, like that. But let's wait until next week. Then we'll see how we want to cover that. But before then, please go and revise this and revise it over and over again, because this might be your saving grace in the exam. And don't joke with it. So I'll stop here for today. Do we have any questions?